Two people buy the same stock on the same day. 5 years later, one of them has doubled their money, the other one lost almost everything. Same stock, same price, same company. So what was actually different? It was not the stock. It was not the timing. It was one decision made over and over again that most first-time investors don't even realize they're making. In the next few minutes, I'm going to show you the single biggest mistake that wrecks first-time stock market investors, why your brain is actually working against you here, and the one simple rule that separates people who build wealth from people who just gamble and call it investing. There's a quick quiz coming up too. Be honest with yourself when you get there. Let's start with what actually happens in someone's first year of investing. You open a demat account, you put in some money, and almost immediately you start checking the price. Every day, sometimes every hour. The stock goes up 2% and you feel like a genius. It drops 3% and your stomach drops with it. This feeling right here is where almost every first-time investor gets destroyed. Economist Terrance Odean at the University of California studied the trading behavior of thousands of retail investors. His research found something remarkable. The stocks people sold went on to outperform the stocks they bought to replace them. In plain English, investors were selling their winners and buying new stocks out of impulse, and it consistently made them worse off. Not occasionally, consistently. Why does this happen? Because of a concept identified by psychologists Daniel Kahneman and Amos Tversky, whose work eventually won a Nobel Prize in economics. They called it loss aversion. The pain of losing money feels roughly twice as intense as the pleasure of gaining the same amount. So when a stock drops, your brain doesn't calmly assess the situation. It panics. And panic makes you sell at exactly the wrong moment. Here's your quiz. Picture this scenario. You bought a stock at 100 rupees. It drops to 70. There's no bad news about the company, no scandal, nothing has actually changed. It just dropped because the overall market had a rough week. What do you do? 1. Sell immediately to stop further loss. 2. Check if anything about the company itself has actually changed and hold if it hasn't. 3. Buy more because it's now cheaper. If your instinct was option 1, you just described almost every first-time investor who's ever lost money in the market. And that instinct is exactly what we are fixing today. You've made it this far, which tells me you're serious about doing this right. If this is helpful, hit like, share it with someone who's just starting out, and subscribe to Invest Hour. It genuinely helps this channel keep making videos like this. Now, back to that quiz. The correct instinct is option 2, and sometimes option 3, but almost never option 1. Here's the rule that fixes everything. Separate the price of a stock from the value of the company. The price is what the market feels today. The value is what the business is actually worth. These two numbers agree with each other over long periods of time, but they can disagree wildly in the short term, sometimes for months. Warren Buffett has a simple way of putting this. He says the stock market is a device for transferring money from the impatient to the patient. First-time investors treat every price movement as new information. Experienced investors ask one question before reacting to anything. Has the actual business changed, or has just the mood of the market changed? If the business hasn't changed, a price drop isn't a warning sign. It's often an opportunity. If the business has genuinely changed, that's a different conversation entirely. Here's how to actually apply this before you ever buy a stock. Write down in one sentence why you're buying it. Not the price target, the actual reason. What does this company do and why do you believe in it? When the price moves later, and it will, go back and read that sentence. If your original reason still holds true, the price movement is noise. If your reason has actually broken, that's when you reconsider. This single habit would have saved most first-time investors from their worst decisions. Not a better stock pick, not better timing, just the discipline to separate a moving number from the reason they believed in it in the first place. Two people bought the same stock on the same day. The one who won wasn't smarter and they weren't luckier. They just didn't let a number on a screen make their decisions for them. The next time your stock drops and your stomach drops with it, remember this video. The mistake was never the stock you picked. It was letting the price pick your next move for you.